All right, let's jump right in. Imagine this. It's February 2026. Two numbers just flashed across the screen, and they've sent the markets into an absolute tailspin. And for the Federal Reserve, well, it's their worst nightmare come to life. There's a quote floating around that just nails the situation perfectly. It captures this total crisis, this idea of two completely opposite forces crashing into each other at the exact same time. It's a classic economic trap. So let's break down what's really going on here.
Okay, first up, the ICE part of the equation. The latest data is in, and wow, it looks like the economy has just slammed on the brakes. We're talking Q4 GDP growth coming in at a shockingly low 1.4%. I mean, that's not just a miss, it's a massive miss. It's a huge sign that the economic engine is seriously sputtering.
And now for the fire. So while the economy's freezing over, inflation is just roaring back to life. And we're talking about core PCE. That's the Fed's favorite way to measure inflation because it smooths things out by ignoring food and energy. Well, that number just surged to 3.0%. That is way above their target. So think about that for a second. The economy's slowing down, but prices for everything are still going up. So you've got this totally contradictory situation, right? Cold growth, hot prices. People are calling it the ice hot scenario. And let me tell you, it is a very rare and incredibly dangerous combination. It actually has a specific economic name, a name that policymakers absolutely dread hearing. And there it is, stagflation. It is literally the worst of both worlds. You take the stag from stagnation, that's the slow or non-existent growth, and you mash it together with the flation from inflation. This right here, this is exactly why economists and especially central bankers have nightmares about this scenario. And just look at this to see how badly the so-called experts missed the mark. I mean, the consensus, what everyone was expecting, was a pretty healthy 2.8% growth with inflation coming down. But what did we get instead? Half the growth and prices soaring through the roof. That, my friends, is what you call a true data shock. So, this massive data shock, it leads us directly into the Fed's nightmare. They are now officially caught in a classic catch-22. A situation where any move they make, any lever they pull, could actually make one side of the problem a whole lot worse. Okay, so you might be asking why? Why is the Fed so trapped here? What is it about stagflation that makes it so ridiculously hard to fight? This right here explains the dilemma perfectly. On one hand, the Fed could cut interest rates to try and get the frozen economy moving again, right? But the risk there is huge. You're basically pouring gasoline on that inflation fire. Okay, so what's the other option? They could raise rates to fight the fire, but if they do that, they risk shoving the already sputtering economy into a full-blown recession. There are just no good options on the table. All right, let's pivot and look at how this is actually hitting the markets in real time, because this isn't just some economic theory, okay? This is having a massive, immediate impact. Specifically, it's triggering a gigantic financial squeeze, and it's all centered on the US dollar. Get this, a stunning $20.5 billion was bet on the idea that the US dollar would get weaker. But then this inflation shock hits, and guess what? The exact opposite happens. The dollar suddenly gets stronger. Now, this puts unbelievable pressure on everyone who made that bet. They're forced to scramble and buy back dollars just to cover their losses, which only pushes the price even higher. And that, folks, is what traders call a short squeeze. So right now, there are two critical battlegrounds you've got to be watching. First is the US dollar index. You'll see it called the DXY. It basically measures the dollar's strength against other big currencies. Well, it's breaking above a super important level, 98.00, which is just feeding this whole squeeze. And the second thing, Bitcoin. It's desperately trying to hold on to support at the $64,000 mark. If that level breaks, watch out. It could trigger a much wider sell-off across the board. So, in the middle of all this chaos, this complete nightmare scenario, where on earth can investors find some safety? Well, the analysis we're looking at proposes something called a stagflation sanctuary. It's a strategy built specifically to find assets that can actually survive and maybe even thrive in this exact kind of economic storm. And the core idea, the whole thesis behind this strategy, is surprisingly simple. It's one word: physicality. The thinking goes like this. In a world where financial assets are going wild and inflation is making the value of your money pretty uncertain, the safest bet is to own stuff that's tied to the real, physical world. Okay, so asset number one in this sanctuary, Constellation Energy. Here's the logic. The demand for energy, especially with all these power-hungry AI data centers popping up, is just relentless. It never stops. And Constellation, with its fleet of nuclear power plants, provides constant 24/7 power. That kind of baseline energy is absolutely essential, which makes the company a super critical physical asset. Next up, we have Freeport-McMoRan. They're a huge copper producer. Now, copper, sometimes people call it red gold, is a classic physical commodity. It has a long history of doing really well when inflation is high. So the idea here is pretty straightforward. It's a primary shield against all those rising prices we're seeing.
And for our final asset, we've got ARM Holdings. Now, this one might seem a little weird, right? It's a tech company, but its value is actually tied to a critical physical constraint: energy. See, in a world where everything costs more, power efficiency basically becomes its own kind of currency. And ARM, they design the blueprints for the super efficient, low-power chips that make our entire digital world run. They save a ton of a very crucial, very expensive physical resource. So all of this really leaves us with a big, critical question to chew on. In a world that's becoming more and more digital, with AI and everything else, does a shock to the system like this one reveal that maybe, just maybe, the ultimate economic safety is still found in the real, tangible, physical world?